And if you're not creating capital, you're not going to get the growth. Without growth, you're just going to get stagflation, which is why I like gold. I didn't say I didn't like silver. I said I like gold more than silver.
Hello there, my friends. Chris Marcus here with you for Arcadia Economics, and excited to dig back into the markets with Michael Pento of Pento Portfolio Strategies, who was on the show. It was right before the New Year and Christmas last year, and we were talking about some projections, how the markets might play out, and then obviously this year has gone quite divergent from the script. So, Michael, great to see you again, and welcome on back in. How's everything going with you today?
Thanks, Chris. Thanks for having me back on. Did I mention December anything about a Wuhan virus back then?
I don't think that
I
was
don't think so, right?
That would have been a good forecast.
That good. I'm not that good. No, that's for sure.
Well, one thing you talked about was inflation back then and whether we might see that pick up. Now we've had this big, other element thrown in with demand. So I'm curious how you look at that and balance those factors, and then having the Fed doing unlimited printing. Where does that leave us?
Well, it just goes to show you, first of all, it's very hard when you get somebody on TV who will come on and tell you, I predict the S&P 500 will close at 3,300 this year because I know everything's going to happen between now and in the next 12 months. They just have no idea. This is why I created my inflation, deflation, and economic cycle model, precisely because you don't know everything that's going to happen. What happens if there was a global pandemic which shuts down the economy? Are you going to stick to your projections, or are you going to change your allocation? Are you going to buy more bonds? I did. Are you going to buy some more gold? I did. So you can project the best you can, but you have to also be flexible, which means you have to be an active manager. So let's just talk about inflation. You mentioned inflation, so we could talk for an hour on inflation. But what happens when the pandemic hits? Well, people run to U.S. dollars. They sell foreign equities, they sell US equities, and the dollar rises, inflation gets crushed, there's no activity, velocity of money goes to zero, and you have to be allocated towards what? Deflationary hedges. But then something strange happens. The Fed comes in with unlimited QE, takes interest rates to 0%. At one time they thought they were going to go to 3.5% and drain the balance sheet back down to normal. That didn't quite happen that way. At last check, the balance sheet was $7 trillion.
Yep.
Do you know that it was $800 billion in 2007, the end of 2007? So it didn't quite work out that way. So then you go from zero growth and zero inflation with a massive, temporary, kind of like a V that needs a lot of Viagra, and you have this nice bounce in inflation. You have a nice bounce in equities. I rode that. First, I rode the market down by shorting it. Then I, rode some of it up, not perfectly. Believe me, I'm not perfect here at all. But I rode back that partial V, that sort of like reverse square root sign. And now we're seeing that the virus is making a resurgence. Unfortunately, hospitalizations are up, deaths are up in the Sun Belt. So we're seeing parts of the economy start to be locked down again. Here's another thing that you should know. The $2.3 trillion in helicopter money and stimulus, the $600 billion in enhanced unemployment, $1,200 to every man, woman that made less than $198,000 married filing jointly. Well, that's been spent. $500 per child, that's been spent. PPP loans have been spent. So now what? So, the House passed a $3 trillion HEROES Act. That's not going to get passed by the Senate. So on the second derivative basis, you pass 2.3 trillion. Suppose they pass $1 trillion stimulus package. Doesn't that mean that, there'll be less growth and less inflation going forward here? And, who's going to supplant consumers? This is the reason why we're not falling off a cliff in the economy as much as we should be. We still have a very, very bad economy. As a matter of fact, I want to touch on this. I'm sorry, I'm rambling here.
No, please.
You know what bothered me a lot, Chris, is I was watching CNBS when they announced the Thursday initial jobless claims. Oh, Chris, don't you know that it was much better than expected? Only 18 million people. But that's if you use Enron, Department of Labor accounting. I shouldn't even blame the Department of Labor because they actually report something called pandemic unemployment assistance. Do you know that that number went up, not down? So if you look at the total number of people that were collecting some form of benefit, 32 million people, up 1 million from last week.
Yeah.
So this is good news. This is better than expected. Crap. No, there's 32 million people that are looking to be able to eat and pay their mortgage and their car payment, their student loan payment, which, by the way, all these forgiveness programs are rolling off at the end of the year, now and towards the end of the year. They need a check, and they need a big check, and that's going away. So we had deflation. So you asked me in December, and I didn't give you an S&P 500 prediction, but I did give you my model. So you had deflation, inflation, and now I think you're going to have growth decelerating along with inflation going out towards the end of the year. But that's predicated upon how much fiscal stimulus comes from DC.
Yep. Yeah, and that's the thing where, I mean, at the end of the day, it's almost no matter what happens, the Fed is you just assume that the numbers are going to keep getting bigger and they're never going to stop. And it's like the only thing, I don't know what else they could do. Maybe if they actually sent Ben Bernanke out in a helicopter with the stimulus checks. I mean,
well, you have to think about this. So before the Great Recession, our annual deficit was around $300 billion.
Yep.
Well, this didn't make headlines on CNBC for very long, if it was up there at all. But the monthly deficit, now I'm going to say this very slowly because I don't want to be misconstrued. The monthly, yes, I didn't misspeak, the deficit for one freaking month was $865 billion. Hello, Chris? 1 month, 800 billion. And that's part of the $4 trillion annual deficit for fiscal 2020 before DC passes another of their, stimulus packages. So this is where we're at. I mean, how can the Fed ever stop monetizing the debt? Let's just say the average interest rate on the 10-year note from like in the modern era, so from after World War II to the year 2000. That's the modern era before the central bank decided they could just take over interest rates. 7%, 6 to 7%, 10-year note yield. Well, the 10-year note yield now is 0.6%.
Yep.
So when you say, and by the way, during that time that I mentioned from 1945 to 2000, the deficits was very, very, very capable to be, below, single-digit percent of GDP. Now the deficit as a percent of GDP is what is that? 20%. I'm laughing because it's asinine. The deficit is 20% of GDP. The monkeys in DC want to add to it, and I said, listen, let me preface it. I feel terrible for people who need help, but people who need help, we have automatic stabilizers built in. It's called unemployment insurance. Why did we need to send people an extra $600 on top of the $1,200, on top of the $500 per child? Why do we need to send all these money to people who may or may not even have been laid off? I mean, you got your $1,200 in helicopter money, whether you were laid off or not. That's how much we care about deficits. So, if Mr. Powell stops printing money, you're not going to go from, so you're not going to go from like 5% to 6% on the 10-year note. You're going to go from 0.6 to 6%. That's what happens when the Fed exits. But it might even be a lot worse because when have we ever had $4 trillion in an annual deficit? The biggest deficit we ever had was 1.4 trillion in 2009. So where's the money going to come from? If the Fed steps away, they're never going to drain their balance sheet. They're never going to stop printing money because the second they think they can, who's going to buy insolvent junk bond debt?
Nope.
They've been propping the repo market up. They've been propping the junk bond market up, corporate debt market, municipal bond market, the stock market. So they can never stop printing money, ever.
Yep.
This is why shows like you are exploding in viewership. Because who's going to come on and cogently have all the numbers in their head, like me? You have me on. They won't have me on anymore. If you heard someone like me talk, let me see, S&P 500 earnings this quarter are supposed to be down 45%. You tell me what reason on God's good earth should the stock market be at an all-time record high? Chris, the three biggest stocks by market cap are all about 1.6 trillion. You know, the Amazon, the Apples, the Microsoft. That's 25% of US GDP. Three stocks. Oh my God. I mean, this is crazy. It's insane. That's why they won't have me on. You hear this, you'd be like, oh my God. I mean, am I in my 60% in stocks and I'm 40% in bonds and I'm protected because both are in a massive bubble, and don't you know I'll be fine the next time the market collapses? No, you won't. Because when the market collapses next time, you're not going to make any money on your bonds because they're already close to zero. And you're going to lose 50% to 80% on your stocks. See you later, retirement.
Yeah, and that's why I appreciate that, you're not just saying this now. Again, you were one of my early teachers, about a decade ago. And it's funny, at the same time, we're seeing Tesla quadruple. I realized it had quadrupled from where it was before the Fed started the repo lines, which I'm sure is just a coincidence. And the last I looked, I thought it was a $900 stock. And I happened to see yesterday, it was almost $1,800, but I'm sure that's not connected to what's going on. So Michael, I appreciate that you've always spoke what's happening, and you've been right about things, and we don't know the timing of when gold goes up or down. Although, speaking of gold and silver, you knew I was getting there.
Before you get there, before you leave Tesla, do you know its market cap is bigger than all of the U.S. automakers combined?
And they've never made a profit yet. Is that correct?
No, they have the cash flow positive. Yes, they said, but not anywhere near the number of automobiles and margins and vehicles sold by GM, Ford, and there's just no way that you can justify this, other than the fact that the Fed has completely falsified all asset prices and every fixed income instrument. So you need to get a yield somewhere, and you can't get it. There's no yield in Tesla, but you can get a return, a very dangerous one, by the way, a very dangerous one. But everybody's chasing the momentum stocks. That's why you see, Facebook, Apple, Amazon, Netflix, Google, they're all piled into these tech stocks, which are supposed to be immune from economic hardships. You give Robinhood investors money to gamble from helicopter money. That's what they're going to do. But boy, oh boy, that exit door is very narrow, and it's, you'll never get through it unless you leave now.
Yeah, you're spot on. It's ironic. I'm reading Benjamin Graham's The Intelligent Investor right now, and they talk about, they're going through these examples, right, of the internet days where stocks were tripling in a week. And but I think there are people who are seeing the insanity, turning to gold and silver. So love to hear your thoughts on the gold and silver markets and what you're seeing there.
So I love gold. I love gold. Some people call me a gold bug. However, I'm not always long gold, surprisingly. I don't want to be long gold when growth is accelerating and interest rates are rising. I never want to be long any gold, maybe 5% max. But right now the portfolio is 20% long gold, and I'll tell you why. The Fed is pretty much, well, not pretty much. Let me quote Mr. Powell for you. The Fed is not even thinking about raising interest rates. So if I know that my cash is going to get close to zero, okay, then the Fed says they're going to kind of think about yield curve control. So they're even bending down the longer end of the curve. So the 10-year note, as I said, was 0.6%. And the Fed has an inflation target now, which is, we need to be at not just 2%, Chris, any longer. We need to be above. It's an equal weighted target. In other words, equilibrium. So if we were at zero, we got inflation data today, which showed year-over-year inflation, CPI 0.6%. So if we're close to 0 on inflation and 2% is our target, we need to be 4. The way the Fed measures it. So the Fed is going to have to measure CPI, or they have the core. It's even worse. So CPI is always above. The core PCE deflator, don't you know, which takes out everything that ever goes up. If that goes to 4%, we'll start thinking about raising interest rates. Yep. So this is good. You asked me about gold. I'm getting there. So if I can get, here's the calculation. This is what gold really cares about. If I can get 0% on my cash, and then that's my nominal return, and inflation is rising the way they measure it, then real interest rates are falling, then I have to own gold. There's just no two ways about it. And the longer this BS continues is where they want to peg interest rates to 0 because you can't afford the amount of debt outstanding unless borrowing costs are 0. So you have to control the whole yield curve, borrowing costs are 0, and you're in endless pursuit of their holy grail of inflation. Inflation. The central bank is desperately seeking inflation. I mean, we used to be they need stable prices, but now with stable prices is now 4%. Yeah. Year over year core PCE inflation. So I think you should own gold. The only time that would change is if I see some kind of liquidity crisis like we saw back in the fall of 2008, or you saw another one in March of 2020 where, hey, we have a liquidity crisis here. The Fed stepped away. I don't see that happening for a very long time, but they stepped away, no liquidity, and you sell everything that's not dollars. You need to get into short-term, T-bills, cash, and physical dollars. That's the only reason why you would sell gold. And that's probably not going to happen for a very long time. And the only other reason is if magically the Wuhan virus dissipated, there was a vaccine that cured everything, no more hospitalizations, no more deaths from the Wuhan virus. And the vaccine comes in time that the household balance sheet doesn't suffer more disrepair. Yep. In other words, we already destroyed the corporate balance sheet. We already destroyed the sovereign balance sheet. 1 in 5 companies now, by the way, are zombies. That's 20% when I went to school. So 1 out of 5 companies are zombies, meaning that they can't pay interest expenses on the debt outstanding from their income.
Don't worry, Michael. The Fed will buy that soon too, so it's okay. Last one for you. I'd love to get your take on silver. We mentioned right before we hit the record button that we're seeing more institutional money flow even into the silver equities, which often historically it's been gold moves first and maybe silver, the gold equities somewhere in there, and silver equities last. Love to hear what you're seeing there.
Okay, so here's where I come down. I like silver. I like gold more than silver. And here's why. Because silver is an industrial commodity and a monetary metal. So you have to look at both. Gold is a currency. Gold is different. Gold is real money. So in this environment where we've seen exponential growth in debt, normally when you think about growth comes from you can get growth from debt if the debt incurred is being used to purchase capital goods. In other words, I'm taking on debt, but I'm growing my business. In the long run, that's good news. But what kind of debt have we seen? It's been the worst kind of unproductive debt ever in history. So you're not taking out debt to purchase capital, to invest in anything tangible. You're taking on debt to what you were doing before was buying back stock, but now you're taking on debt just to give people money so they can go out and consume, so they can eat and pay their electric bill and put clothes on their back. There's no capital goods formation, a surge going on in the United States or anywhere else around the world. So growth comes from capital formation. And if you're not creating capital, you're not going to get the growth. Without growth, you're just going to get stagflation, which is why I like gold. I didn't say I didn't like silver. I said I like gold more than silver.
Well, Michael, I appreciate that. I appreciate you always saying what you feel, whatever it is. I know some people, because I talk about silver all the time, I just love hearing the different opinions that are out there. And for folks who would like to find out more about what you guys are doing and can help them with, could you just give us a minute on Pento Portfolio Strategies?
Sure. So the website is pentoport.com, P-O-R-T. And, there you could see the midweek reality check, which is my weekly podcast, $49.99 a year. You get access to information that you won't see anywhere else. So at least you'll see it maybe for a second. They'll take it off really quickly because they don't want to lose advertisers that just advertise because they want stocks to go up perpetually. That you won't get that from me. So it's a trial basis. 5 weeks, you don't like it, you can discontinue that. If you have around $100,000 to invest, I will personally take care of your money in the inflation, deflation, and economic cycle portfolio, which tries to make money when things are good, when we're inflating and growing in a safe, with ballasts in the portfolio. But most importantly, we'll try to protect and profit from this epic resetting of markets and the economy. We're at, Chris, we're at a record 152% of GDP is the market cap of equities. So 1.5 times the entire US economy is the valuation of equities. When earnings are going to be down 44% and we have a global pandemic. Think about how, and I love this word, the falsification of asset prices that have been perpetuated by the Federal Reserve. And it's that eventually the market, nature doesn't like vacuums. Eventually, there's going to be mean reversion. And I want to capture that. I've had a history of doing it. I have this model which intends on shorting the stock market when the time is right. And it will come again. And boy, you'll want to be out and short when this big washout comes. Because whenever, I'm going to say one more thing. I apologize if I'm rambling. Oh. When the Fed achieves, not just the Fed, but all central banks, when central banks achieve inflation, and that starts to run intractable, they get their 4% and it goes, mid single digits, then it goes higher, and then they're forced to do what? They can do one or two things. I mean, the bond market, whatever's left of the free market and bonds will be in full revolt. So they could either, stop printing money and add to that because, if they stop, the primary buyer of bonds is going to go away and inflation's running amok. Well, what's going to happen? The 10-year treasury is going to go to record highs in yield. Or they can say, you know what? We're going to pin the long-term treasury note to, 0.6% or whatever number they pick by just printing money endlessly. But if you already have an inflation problem, the promise to never stop printing money isn't really a good recipe to boost the confidence in the purchasing power of the dollar. So every fixed income instrument that the Fed isn't actively purchasing will explode in yield and implode in price. That's what's going to happen. So you want to be an active manager at that point who knows what they're doing. I've been doing this 30 years, licensed professional for 30 years, managing money here in Pento Port since 2012, and under the IDEC model since 2016. You can look at my track record. I think it's pretty good. I certainly don't want to be I certainly don't want to be a sitting duck or a passively managed pigeon when that wipeout comes.
I hear you, Michael, and it's going to be fascinating to see how it unfolds. So, folks, you can get more info about Pento Portfolio Strategies at pentoport.com, which is in the description link below. Thanks again, Michael, for checking in. It's great to keep in touch and appreciate all that you stand for, all that you do, and that for people who are looking for more active help during these times, that you're a resource, and we'll look forward to checking in with you again soon.
Thank you for all you do as well, Chris. Stay well.